There is a question here. James Hemming, the chief financial officer of a Midwestern machine parts manufacturer, is considering splitting the company's stock, which is currently selling at $80 per share. The stock currently pays a $1 per share dividend. If the split is 2-for-1, Mr. Hemming may expect the post split price to be. So, what happens when there is a stock split? The there would be no additional amount collected, or there's no capital which would be collected, but um, the number of shares would increase by whatever is the policy they have adopted. Here in this particular example, we see that, see, it would be 2 shares for 1 share. So every one single share will be multiplied. So accordingly, the price or the selling price of the share will get adjusted. See, 1 share, when it is at the value of 80, now 1 share, now this 80 would be intact, but this 80 would be for 2 shares. So each share would be at the rate of half of it would be. So it will become at $40 per share. So we see that the share price has become $40 per share, and the number of shares have multiplied, they have doubled, because the policy what they have followed was 2-for-1 share. So as of now, whatever are the number of shares of James Hemming, they have of this Midwestern machine, so they would be doubled, done. So there are 4 options given. What is the right option? We have to choose exactly 40 regardless of dividend policy, greater than 40 or greater than 40 if the dividend policy changes to 0.45 or 0.55, then less than 40 regardless of the dividend policy. Now, according to dividend policy, we understand that the amount of dividend paid to the shareholders will have a positive impact on the share price. See, the shareholders, when they invest in the shares, that is with an expectation that they would earn returns preferably in the current period, because see immediately what returns they earn matters to the investors, to the shareholders. So immediately if they receive a dividend, a better dividend, that will have a positive impact on the value of the shares. Because when you study the dividend policies, so that is very clearly explained there in the dividend policy. So as of now, we remember that, see, if the dividend is paid to the shareholders, it can be, I mean, the positive impact can be seen on what is the price, share price. So now, as of now, the dividend paid is 1 per share. Okay, the company, the stock currently pays a $1 per share dividend. So this also will be divided, because the number of shares are now more in number, double in number. So the share price has become half, dividend also will become half. So dividend is 0.50. See, when the dividend per share is 0.50, the share price, the market share price is at 40. Now, if there is a, I mean, if a positive impact should be seen on the share price, then the amount of dividend paid should also increase. We rule out option A and option D because, see, regardless of dividend policy, see, dividend policy has an impact on the share price. So A and D cannot be correct, because they say that regardless of dividend policy, they are interconnected. We can understand that by the ratios, dividend yield ratio, which is the dividend paid per share, DPS, divided by market price per share. So there is a relationship between this. There's another ratio, this which is inverse of dividend yield ratio, which is price earnings ratio. The market price per share divided per share by earnings per share. So we see that whatever is the earnings which is earned has an impact on market price. What is the amount of dividend paid also has an impact on the market price. So to have a positive impact, the amount of dividend paid, if it increases, we will see a positive impact. Otherwise, it's a negative impact. So now B and C talk about greater than 40 if the dividend is changed to 0.45. As of now, it is 0.5. So to have a greater value, the dividend paid should be greater than 0.5. So on that note, C will be the answer.